in this environment, it's almost like going back to old school investment principles that you can't just find a stock that you think, this has a good future prospects. It doesn't have any earnings at the moment, and it doesn't even have any revenue, but it's got this good idea, and it's investing in building out this idea, and therefore we'll back it. That was like really. Well, actually, I always found it really hard to deal with a market where the cost of capital was really cheap because valuations didn't really work. You're always forced to pay too much money for a share. So I actually really enjoy this market because there are so much more opportunities. The share prices doesn't move as much, but intrinsic value will still grow if you've got a business that you're paying a reasonable price for and it's still generating cash, whether it pays that out as a divvy, whether it reinvests back in the business. You can set yourself up for good long-term returns in this type of market by doing your homework and building up a portfolio of good stocks at good prices.
Hello, and a warm welcome to What's Not Priced In, the best investing news show in Australia, if not the world, dare I say it. Greg, welcome back. Good to have you.
G'day, Kiryll. Is that a self-proclaimed title, is it?
It's anonymous sources have told me.
Fair enough.
Well, look, I just wanted to introduce the show. I think we were having a nice discussion off camera on chat before that this show always tries to ask the most important question in investing, which is not are rates going up or down. It's asking what is the market pricing in and what the market isn't pricing in. And we'll get to all of that later today. I think we'll talk about the RBA's latest updates, and Michelle Bullock obviously made a speech that I probably made more of than you did, and we'll talk about that later. The market didn't really react that much, but there was an interesting thing that Michelle Bullock said about demand, and I think you've got some thoughts on that as well. So maybe actually we'll start with that. Did you actually get to catch Michelle Bullock's speech on Wednesday?
No, I didn't. I didn't really dive into the speech. I read a few articles on it, but unlike you, I think you watched it a couple of times, didn't you, mate?
Yeah, well, I read it last night and then I watched it this morning. So I consumed it in different ways. But it was an interesting speech. I do think she's got a nice way of communicating, and she did sort of address something that we've talked about throughout maybe the last month or so. And in one of the episodes, you did sort of say raising interest rates would be a dumb decision because it doesn't necessarily impact rent or housing or electricity. And in this speech, she actually did tackle that head on. And she said, yes, monetary policy is a very blunt instrument. We can only really raise rates, and rates really only influence aggregate demand. So if there are issues with supply like housing or rent or electricity, they can't really do much about it. But she did say she thinks supply isn't really an issue that much in Australia anymore for inflation. And she made the big claim that right now it's domestic-driven demand. And she made the case with like some interesting charts that in Australia, its aggregate demand is sort of outpacing supply. And that's what she's worried about. And she then said the battle to bring inflation down from where it is now to below the inflation target is going to be a long one. But yeah, I thought that was interesting because she almost directly referenced our podcast. I'm not sure whether she watched it or not, but she definitely did address it.
Safely say she probably hasn't seen it. But look, I mean, I think it's important to notice what central bankers are saying, and in my view, what she's really trying to say to the market is, we are still focused on containing inflation. Yes, it's a blunt instrument, but we will use a blunt instrument if we have to. But I thought it was interesting that she sort of made that point about demand and supply, and that in effect that monetary policy still has a job to do on the demand side. There was a really interesting article that Robert Gottliebson wrote in The Australian this week that talks about the issues from a non-academic perspective. And I think the problem with central bankers is they come through the world of central banking and they don't necessarily live in the world that a lot of other people live in. So I'm just going to read a bit from this article because I think it all puts it into perspective. And it starts off with around 30% of Australians are being persecuted mercilessly in the drive to squeeze the economy to beat inflation. Most of the 70% majority of the population are either prospering or not being severely impacted. In combination with rampant state and federal government spending, the prosperity of this 70% intensifies the required attack on the 30% minority to beat inflation. Unless we wake up to what we are doing to our nation, the sharp divisions created in society will move from political issues to the fundamental structure. The inevitable turmoil will create scars that will rank with the two world wars and the Depression, and the long-term damage created by the attack by the majority on the minority will be made worse because victims are dominated by people in the 25 to 35-year-old age bracket. They will never forget the artificially imposed cost of living crisis that was imposed on them. We need to recognise first that the Reserve Bank interest rate increases are a very blunt instrument in dealing with government-boosted inflation. It concentrates the burden on a small group. Those forced into crisis are not responsible for that crisis, and there is little they can do to solve this crisis except continuing to tighten their belts. Some move below the poverty line. This has little effect on inflation and the imbalance of supply and demand. They are not lifting prices. And then he wrote that in conjunction with a guy called John Dalson, who's in the building industry, former ANZ bank executive. And he writes, John Dalson knows most aspects of the building industry and sees that at the core of the rent and the home purchase crisis is the fact that state and local governments add about 40% to the cost of each dwelling in most Australian capital cities, particularly in Sydney and Melbourne. Taxes like stamp duty are a big contributor, but so are the massive local and state government bureaucracies who devote their lives to delaying permits and approvals and adding costly building regulations with very little regard to costs. So when I read that, I went and had a look at the Australian Bureau of Statistics data, who have recently put out information on the amount of public service employees that we have and their average wage and salaries. And I noticed that in Australia, we have 2.4 million government employees, so nearly 10% of the population are employed by government, federal, state, or local government. 1.87 million of those are state government employees, and the average wage for each of these employees, the federal average wage is $97,000. State average wage is $88,500, and for local government, the average wage is $73,000. So we are paying significant amounts of money. And if you look at it from a very broad perspective, government does not necessarily add any productive capacity to the economy. There are obviously, there's a necessary element to government where you need to make sure things are running smoothly, rules are adhered to, all those sorts of things. But there becomes a time when it just becomes bureaucracy, and bureaucracy adds more costs. And that is the whole point of this article and the whole point of what I was talking about. The RBA can raise rates and raise rates and raise rates, but the pain is being felt on a small amount of the population that have a very limited ability to impact on inflation or at the end of the day, demand. If you're getting paid a big chunk of money for contributing nothing to the economy, then that's inflationary. And the biggest employer at the moment, in far as I can see, is the government. So that's where the problem lies, and I think that's what should be talked about more. I think Bullock's probably talked around that issue a little bit, but at the end of the day, she's just telling the market, hey, we're still concerned about inflation. We are probably have a tightening bias. The market fell a little bit this morning, probably on the back of those comments. So it really doesn't change too much to what we've been talking about. The higher for longer mantra, which has been in effect for some time. I guess the difference in Australia is because we have probably more of an inflation problem. And there was a report, I think, from The Economist last week saying that Australia had the highest levels of inflation for any developed economy. So we are getting that entrenched inflation, which is to do with an unproductive economy. It's not to do with so much money in the economy that, the private sector is spending too much. I think it's too much going through the public sector that's creating those inefficiencies. So at the end of the day, the US market, I think, is starting to price in a peak in interest rates, and maybe they're starting to price in lower rates next year. Whereas in Australia, I think the Reserve Bank needs to keep pushing back on that, and that's what last night's speech was all about, without labouring the point too much.
Yeah. Yeah, briefly before I think she did address that issue. She admitted that she gets letters from people who are upset that their cost of living is going up, and she did admit that interest rates are impacting some portions of the community much harder than others. But she sort of did say, maybe a little bit coldly, that her mandate, or the Reserve Bank's mandate, is to address economic issues on the whole in and aggregate demand. And so I think maybe she was sort of saying that's just the price you have to pay to
She's
bring
basically
inflation
saying,
down.
we know we've got a blunt instrument, but we'll use it anyway.
Yeah, we'll
Yeah.
cudgel anyone. But this issue of aggregate demand still sort of exceeding supply does lead on to the next topic, which is retail stocks. I think there's been a lot of AGMs lately this week and last week. A lot of them have been retail stocks. And I know you've sort of have some charts that you wanted to show us. I think there was Accent Group released a trading update. There was Lovisa or Lovisa, the jewelry store. I think Kogan released an update today as well. I think year to date, its gross sales are down, even though it tried to highlight that October was a good month. So the retailers are maybe their sales aren't exactly rebounding. But what did you make of it with your
Yeah, well,
charts?
look, I think that the point that we wanted to make here is that the demand side isn't strong, and the governor's saying that demand is the issue. And look, I think in many cases that is, for your small businesses and services, if you can raise rates. And just as an anecdotal example, I get my haircut just around the corner at a local guy's garage. Basically, he set up his shop. He set up his hair barber shop in the garage, and I go there maybe once every, I don't know, 3 months, 4 months, something like that. And each time, over the past 12 months, I've noticed the prices have just been increasing. And I asked him last time, I said, are you just doing that to see where the pain point is? Like, because everyone's raising rates, you're raising rates. And he said, the reason I'm doing it is, he said, I can't expand my business from here. The only way that I can, and he said, I'm getting lots of demand. I'm getting filling up my slots really quickly. So I've clearly got excess demand. So he's trying to deal with that excess demand by raising prices. Now, that's not the case for everyone, but I'm assuming in a lot of small service-oriented businesses where there is a lot of demand, and don't forget we're getting a huge influx of demand through the immigration policy, that is a strategy that a lot of people are using. And then there's obviously just the cost push inflation that's coming through, where people are having to raise prices because they got higher costs to deal with. So, but the other side of the coin is on the discretionary side. And if we look at a couple of the share prices of these retailers, and this is why my view is always that you need to look at share prices, because share prices don't lie. And if we look at, I've just pulled out the big retailers here, so the larger companies that may not necessarily be impacted by small company issues. So you've got Harvey Norman here. That's been in a downtrend for years. It peaked in 2021, made this sort of low in June of this year. It's bounced back, but then it's rolled over again. I mean, that looks really, really weak to me. That's not telling me that there's strong demand at all. JB Hi-Fi, it's holding up, and it's a really, I guess it's a defensive retailer in many ways. It includes the good guys as well. Again, hasn't really sort of dropped hugely. It's sort of, if I go back a little bit here from the COVID crash, it's rallied and then it's sort of rolled over a little bit, trying to make a recovery. So it hasn't really done too much over the past 2 or 3 years. Accent Group, the one that you just mentioned, it's really a shoe fashion retailer. I guess it came out with was it a profit warning, or was it just a lower than expected growth rate? Do you know, Kiryll?
I think I have it here. So, and yeah, like you said, it owns Athlete's Foot, Ugg Boots, Vans, Timberland, Skechers, Platypus. So all those are youth shoes. And it did say that total group owned sales were flat year on year, but like for like sales were down 2%. And I think the biggest thing was that based on the like-for-like sales drop-off, the cost of doing business is going to rise as a percentage of sales, and that's going to obviously impact their earnings.
Yeah. Yeah. So it's sort of like a de facto downgrade, and the share price is obviously sold off from that. So big recovery throughout 2023 after this initial sell down, but then it's not gaining any traction. So clearly these interest rates rises are impacting on the discretionary side. This is Temple and Webster, sort of home decorative, mostly online retailer. Big decline here. Is it priced in? Higher rates, recovering a little bit from it, but certainly not a strong recovery. You just mentioned Lovisa. That had what was its like-for-like sales down? I think it was nearly 9%, was it?
I think it was a little bit less, but
Or
total
maybe
sales for the
6%?
first 20 weeks. Oh, yeah. So total sales were up 17% year on year, but global comparable store sales were down 6.2.
Yeah, so it's a 6.2, and really the growth is coming from the store
Yeah.
rollout. So it's and investors focus on those like-for-like sales because it's trying to compare apples with apples, and down on a global scale, down 6.2%. That's obviously telling you that people are tightening their belts. Premier Investments. This is obviously a quality retailer. Certainly wouldn't say it's in the toilet, but it's not particularly looking particularly strong here either. Nick Scali, really well run furniture retailer. Again, not the worst looking chart in the world. It looks like it's trying to recover here, but certainly well off its highs from back in 2021.
Yeah, I think its CEO just sold 50 million worth of shares.
Yes, exactly. Although could have been for personal/family reasons. You never know these things.
I think he
But look,
called it asset diversification. That was his reason.
yes, but this has been such a great retailer for many years. They generate a huge return on equity, pay a good divvy, and have had a good acquisition strategy. So wouldn't begrudge anyone from diversifying, given that they've put a lot of effort into growing that business. So, but just moving on to Eagers Automotive, it's a used car retailer. Again, it's recovered from the big sell-off from the initial reaction to rising rates. But again, not in any way showing that demand's running too hot. The only retailer that is, I guess, back up near its old highs is Super Retail Group, and it's sort of, I guess, at an interesting point here because it's right at these highs that it's made over the past few years. Whether it can punch above that or whether it's again a bit of resistance and on its way back down remains to be seen. But I just wanted to show those, Kiryll, just to give listeners and viewers an idea that, the demand side is the interest rate rises are having an impact, and it's not necessarily a brutal impact across all industries and all segments, but it is an impact nonetheless. And look, there's other areas of the market that you can look at, and I'm doing an in-depth report on a new recommendation, a stock in the financial services sector. And I went through a whole bunch of financial services stocks. And when I say financial services, I'm talking about, non-bank stocks.
Yeah.
That's a sector that has been absolutely decimated over the past, you could say 12 to 18 months, but some of these share prices hit their highs back in 2018. That's structural. There's structural reasons for that. There's fees that are coming down. Index funds are putting pressure on them to reduce their fees. Scale requirements mean that there needs to be consolidation in the industry. But a lot of these stocks are down 40, 50% from their highs in 2022. So even though the stock market itself is only down about 5 or 6% from its highs back in, was it August 2021, a lot of these sectors below the surface have been really, really badly impacted. And again, that's higher interest rates. Higher rates are causing these asset prices to fall down. Higher interest rates are causing competition because people are happy to stick in cash, and obviously you can't charge as much money on a cash account as you can on a share, a managed fund for a share account. So there's lots of areas where this is having an impact. And And again, it will continue to have an impact because there's still monetary tightening in the pipeline to come through. So we did say a few months ago that we should expect to see the impact of that by the end of the year. So we're fast coming up to the end of the year. So by the time we have a chat in probably our last episode for the year, which will be mid-December. I can probably say, look, it either was right. We might get some data in the next month or so to show that things are slowing more so than what people expect at the moment, or it's not going to come and it's going to continue along its merry way. And maybe there are more interest rate rises down the track, but certainly, I think there are plenty of sectors where it is having an impact for sure.
Yeah, definitely. And before we move on, I did sort of want to make a comment about your hairdresser. And I don't want to be a Michelle Bullock apologist here, but it was just funny because she literally said the exact same thing that your hairdresser was saying, which was the Reserve Bank team is noticing that, especially in the services sectors like hairdressing, the demand is so high that it's just easier for those people to just raise prices rather than to find workers, because the labor market is so tight. There's less spare capacity in the economics language, that instead of looking for another hairdresser to work with him, it's just easier for him to raise prices to fill that demand. So yeah, it's just
Again,
interesting.
no, that is a supply issue in my view. That's a supply issue. And where are we churning out hairdressers and barbers from these days? I don't know. Maybe and look, I'm being a little bit facetious here, but maybe kids. When I say kids, uni students, should maybe not do a psychology degree, because every young kid I speak to these days is doing a psychology degree, and they should go and get a trade, because you'll probably earn a lot more money from a well-run trade business.
Yeah, well, who knows if the hairdressers continue to raise prices, that might incentivize the market to encourage more
That's how it
people to
should
be
work.
hairdressers. Yeah,
Exactly.
but yeah.
But I'm not
Well,
sure kids these days who learn socialism at university will respond to price signals like that.
Yes,
Because someone
well,
else will do it.
yeah.
Why isn't someone else doing cutting hair?
I think I have in my local area blog. There's also a person who does haircuts straight out from the garage, keeps the costs low. But I
Exactly.
think there's also something you mentioned, which was with all of the interest rates rising, and they're probably not going to come down for a while yet. That's putting up the cost of capital. And you sort of sent an email around to our company, and I wanted to get your thoughts on that. And you made an interesting point that since the cost of capital is going to be quite high for the next few years, it sort of makes investors less complacent. You really have to earn your stripes, because you can't just pick a stock that's basically just a concept stock or a story stock that might not have any money or any profitable revenue. So you really have to, dot your whatever it's called, I's and T's, and pick stocks that can actually make a profit. So maybe you could just comment on that, because I think that was a really interesting discussion that you raised.
Yeah, I think what I was getting at there is that in this environment, it's almost like going back to old school
Yep.
investment principles, that you can't just find a stock that you think this has a good future prospects. It doesn't have any earnings at the moment, and it doesn't even have any revenue, but it's got this good idea, and it's investing in building out this idea, and therefore we'll back it. That was like really pre-COVID, and then post-COVID in many ways, where 2021 stocks just blew up, and anyone who had an idea and a concept, and at that time the main narrative in the market, especially for small stocks without earnings and without revenues, was total addressable market.
Yep.
If you had a total addressable market of $100 billion, then this is how we are explaining our story to the market, and we are therefore worth 500 million, because if we capture X percent of that total addressable market, we'll make this much money. Those sorts of investment ideas worked back then, and I just don't think that they work these days. And it was just a comment around saying that you have to, because we had this internal discussion about AI and whether AI can help with analysis and make things more efficient for us trying to do stock research. And at the end of the day, I just said, look, it can help us, but it's not gonna do valuations for you. It's not going to think about how the market thinks and then work out whether that's priced in, which is what we try to do on this show. And we always talk about, and I don't know how to sort of frame this in a clever way, but we always talk about not what I think, but what the market is thinking and how the market's pricing that in. And is there an opportunity? Is the market too optimistic? Is the market too pessimistic? And I think that's a really important thing for investors to think about, not just how do I see this situation, but how is the market seeing it? And is the market right in that analysis, or is it wrong?
Yeah.
And if it's wrong, there's an opportunity there. And that was my point with AI, is that it's not going to clear the burden from you doing hard work in terms of reading as much as you can and understanding as much as you can and doing the valuation work to make sure that you're not paying too much for a business, or that you're paying, a reasonable price for growth prospects or whatever that might be. And when cost of capital is high, that's what it does. It makes you do the work. You have to earn it. When the cost of capital is low, it's just money everywhere, and it's a lot easier to. Well, actually, I always found it really hard to deal with a market where the cost of capital was really cheap, because valuations didn't really work. You're always forced to pay too much money for a share. So I actually really enjoy this market because there are so much more opportunities. The share prices doesn't move as much, but intrinsic value will still grow if you've got a business that you're paying a reasonable price for and it's still generating cash, whether it pays that out as a divvy, whether it reinvests back in the business. You can set yourself up for good long-term returns in this type of market by doing your homework and building up a portfolio of good stocks at good prices. The bull market will return at some point, whether that's next year, the year after, who knows. But this is when you do your work to build out your portfolio and then reap the rewards down the track. So that's the plan anyway.
Yeah.
And that was the idea behind that comment.
Yeah. So you don't think ChatGPT is going to take over the investing industry?
No. Maybe down the track. Who knows? I mean, I'm the worst technologist or futurist you could imagine. So do not listen to me when it comes to that stuff. I'm very, very plain vanilla. If I can't see it immediately, I can't see it at all. Whereas there's some other people will tell you that this stuff is going to revolutionize the world, and in many ways it will. I get that, but I think when it comes to stock research, the market will always. The market's like a psychologist. The market will always find your weak spot. It will keep hammering you until you fix that weak spot. And if you think about the evolution of markets over the past couple of 100 years, we have got so much more information. We have got so much more ability to deal with the information that comes with us and what to do with it. Yet it's still dishing out the same lessons to people for making the same mistakes as it did 200-300 years ago. So I don't think AI changes that. I think AI maybe lifts the level that you have to play at, and you have to think about, what does AI think and what does the market think AI thinks? All those sorts of things. You have to put that into the equation. But at the end of the day, the market is still driven by humans, human emotion, and that's not going to change anytime soon with AI or without it.
Yeah. And I think we've probably already had AI play a big role in markets anyway, with all of the algo traders and stuff like that. So it's been a part of markets, I think, now for years.
Absolutely.
There was something I was going to mention, but now it slipped my mind. So then I think now I'd want to talk to you about Origin Energy. We're recording this at the middle of Thursday, and obviously the vote that was meant to happen on Origin's takeover got delayed. And I think you've been following on Origin Energy for years now. So I think a lot of people are probably thinking, what the hell is going on? So can you please tell us?
Yeah, look, I'm probably in that camp as well. I first recommended Origin back in April 21. I think it was around about 475. And then literally a couple of weeks later, it plunged to below $4. And this was the time when companies like I don't know, Zip and all and Afterpay and all that were going crazy, and I was stuck in Origin Energy with apparently energy going out of business in a couple of years. But that's partly what happens when you're a contrarian / value investor. You just have to suck it up when you get your timing wrong. But I've followed Origin for a good couple of years, and my view is I'd told subscribers a couple of weeks ago to vote against the takeover bid. I think it undervalues the company if you look at it purely from the cash flows that it's generating now and expected to in the next couple of years. The valuable assets that it holds, they're effectively irreplaceable assets. The other thing that this company is getting on the cheap is the 20% stake in Octopus that Origin owns. And when I first recommended it back in April 21, my story led with the strategic investment that it had made in Octopus and said, this is effectively a potential jewel in the crown. You're not paying anything for this business. You're not even paying anything for the LNG business at this point. There's some real cheap assets in here. And Octopus has gone on to be a global growth story that I think is going to be worth, in 5 or 10 years' time, is going to be worth a huge amount of money. And Brookfield are effectively getting it for, bugger all. So, the key shareholders, I think, realise this and have rejected the offer. Just today or last night, the bidders came back with another deal. I haven't had the time to look into that entirely, but it looks like they're trying to, I guess, twist people's arms into saying, look, hey, take this, and if you don't accept this offer, you're going to be looking at a $9.20 offer instead. But I can't see how Origin Energy's board will endorse that. To me, it just looks like a desperate attempt by these essentially private equity guys to try to get the deal done. There is a lot of money on the line for this deal going through, so a lot of personal money on the line for Origin shareholders, Origin management, Origin board members. I know that I think it's Frank Calabria. He has a big payday if this goes through. So it's going to be really interesting to see what the Origin board decides to do from here. But my view is that these are really good assets, and you shouldn't be selling them to bidders for a cheap price. If they want them, they need to pay for them. And they've come out and said their bid was a final offer, so they can't actually best and final, so they can't raise it from here. So they might have to walk away. And if they walk away, does the share price fall all that much, or does the market actually realise there's significant strategic value within those assets? The only downside for shareholders continuing to own it in this structure is that Origin may have to raise capital to fund a lot of its renewable investments. So at the moment, and don't quote me on these figures, but this is just a rough ballpark, Origin have committed to around about, I think it's 5 gigawatts of renewable energy investment, whereas the Brookfield guys have committed to 2 or 3 times as much. And in dollar terms, that's like, well, the media's quoted figures of 20 to 30 billion from Brookfield. But, these aren't contractually agreed to amounts they're going to invest. It's easy to come in and say, oh, yeah, we're going to help with Australia's energy transition. But, these guys aren't doing it to be a good corporate citizen. They're doing it because the government is effectively underwriting their returns by saying, you build a wind farm and we'll give you a guaranteed return on the energy generated from that. And that's going to translate into higher prices paid for by households and businesses. So we're effectively giving away Origin at a time just before household electricity prices are going into a structural rise because of this shift towards renewables. And there is no doubt that renewables are a more expensive form of energy generation. And in order to build out the renewables, the government has to underwrite the returns from it, and those returns will be paid for via the taxpayer, via subsidies, and via the households and business sector by higher electricity prices. So one of the few ways you can hedge that is by owning Origin Energy, and the private equity guys are trying to take it private. So, if I'm a shareholder, I don't really care short term. And I am a shareholder through my super fund. I also own it, bought it for my father's super fund. So, there's a short term, you can say, okay, well, we're going to be down maybe 10, 15, 20%, but you want to own these assets for longer term. You want to generate you get income generation from it, and you've also got the optionality of the octopus business, which is in many ways hidden in that, because it's not generating. It's got a balance sheet value, but it's not generating income as yet, or profits. So those profits aren't contributing to the return on equity profile of the business. So you're not getting that uplift in terms of the overall valuation. So these guys will try to do their best to get a deal done, but I would be surprised if it gets done at all.
Yeah, and I think I know you've said that you've been reading Peter Lynch again a few weeks ago. He sort of mentioned in his One Up on Wall Street that some of the best stocks are the ones that have hidden value in the balance sheet. That sort of the way that they have to account for that asset greatly underestimates the true worth of that investment or that equity stake. So Octopus Energy could be one that
Absolutely.
Peter Lynch would
And
probably
look,
like.
Premier Investments is another example of that.
Yep.
It owns 25% of Breville on its balance sheet. It owns 25% of Maya, which is obviously not quite as valuable, but it holds that value of Breville on its balance sheet at about 330 million. It's only getting the dividends from Breville. I think Breville reinvests 50% and only pays out 50%. So the earnings that it's getting from Breville isn't 100% of the earnings. And the actual market value of that stake is around 800 and something million, whereas it holds it on the balance sheet for 330 million. So there's, you can find those not everywhere, but they are in various spots. The market is pretty good. The market knows this stuff. So the market's pretty good at trying to work out where it is. But often you'll get situations where, especially in panics, and if there's sell-offs in panic situations where everyone prices in this worst case scenario, and you've done your homework on the valuations and you know where the value is, if you get a situation where the panic sees that fall below that value for a short term, you can just buy it, knowing that these are panic values that are creating the share price. It's not necessarily anything intrinsic to the company, and that's where you can get the really good prices. Which goes back to my point about knowing your values, knowing how to value a company. If you do that, and you've got those, and I've got a sheet here with all my stocks in my portfolio. I update the values every month, the ones that I'm looking at. So if things move to a point where there's good discounts on offer and it's not necessarily company driven, I know I can move that from a hold to a buy or whatever it might be, just because it gives you confidence knowing where the real value is, and the market moves around that all the time.
Yeah. You can probably automate that process with ChatGPT. You've got your valuation.
Well, that'd be good,
formula
actually.
updates,
Maybe I should get into it a little bit more. It would help me out quite a lot.
Yeah, because I think with the whole AI thing, I was thinking it's a question of whether it complements your research or it's a substitute for your research, and I think it's probably a complement rather than a substitute. You can't really substitute insight or creativity, and I think the best investors are probably ones that see something that other people don't. And I think you were sort of trying to describe that earlier, and there was an interesting quote from Dan Rasmussen. He was presenting at the Song Hearts and Minds charity event for AFR, and he said that investing is not a game of analysis, it's a game of meta-analysis. It's not what you believe, but what you believe that's different to what the market believes. And I think that's the whole point of this podcast as well. I think sometimes, maybe me especially, I want to maybe raise topics that are maybe too popular and that have already been raised. And so you do a good job of saying, look, the market's already priced that in, or investors have already heard that elsewhere. I think most viewers probably have a subscription to the Australian or the Financial Review, or they can just read it elsewhere. So that's what we aim to do.
That's a good quote. And another thing that Peter Lynch mentioned as well is that investing is more art than science. So he was very much of the view that you need to think laterally, and you can't just sort of go in and I don't know, look at PEs or whatever and say, okay, that's a good or a bad buy. There needs to be creativity put into place. And if you outsource research to a machine, there's no creativity there. So you really need to, as you said with that quote, really good quote. You need to think about what the market's thinking. You can't just sort of go in and not have this idea that the market is a living, breathing thing that is creating prices one day up and down, and you need to work out whether that market is being irrational or being rational. And to me, that's the real challenge of investing, trying to always work that question out.
Yeah, and I think the more I study investing or study the best investors, the more that whole sentiment of that quote I just read pops up. I think Howard Marks famously said it's better to be non-consensus and right rather than be consensus and right. The best gains are in that quadrant where you're non-consensus and right. Obviously, you don't want to be non-consensus and wrong, but you really want to, if you want outsized performance, that's what you aim for. I think we're nearly out of time, but I wanted to do a brief quick fire round and just get your brief thoughts on the trending topics and whether you think investors should just forget about it or not. Obviously, this week was dominated by OpenAI. I'm not sure if you followed it.
Not really.
I'm a big
I tend
fan
not
of.
to follow main headlines.
Yeah,
When
I'm a
main
big.
headlines, it's boring.
Yeah, I'm a big fan of Twitter, so I was on Twitter a lot, and that was the only story that was dominating Twitter, whether Sam Altman is going to be rejoining OpenAI or not. So I've got two images for you, and I'm going to say, is this a big deal or a molehill? So all of the OpenAI shenanigans, is this a mountain or is this a molehill? So which one do you think it is?
I'm not actually sure how to interpret your things, whether it's a mountain or a molehill, but I would just say it's not worth anyone's time
Yeah.
to
So it's not a big deal, it's
think
a
about it too
molehill.
much.
Yeah. All right. So it's
So
not a big deal, it's a molehill.
making a mountain out of a molehill.
Yeah. Yeah.
That's so I could say both.
And I think the other one I wanted to maybe raise is obviously Nvidia. We probably, our first ever episode was it mentioned Nvidia. I think the very first episode coincided with its massive run up in price. It sort of released its earnings, and everyone was surprised at how massively it beat expectations. Obviously, the stock this time around didn't really react as much. It was pretty much flat. So the market pretty much already expects outsized performance. So is it a big deal that this Nvidia's earnings big this quarter, or
It
a
was a big
molehill?
deal because the earnings growth was massive, but
Yeah.
the market had already priced it in,
Yeah.
so it was no big deal from the market. But just to reiterate, and I wrote about this in our free daily email, Fat Tail Daily. So if you haven't, if you're not signed up to that, it's a free daily email we send out once a day. I guess it's just fattaildaily.com.au. And you can put your email address in there and get that once a day. But I just write a brief intro each day. And yesterday I mentioned that, it is a hugely profitable
Yeah.
company. I mean, 80% return on equity, and it's reinvesting most of that money. I mean, the compounding on that is huge. So as much as I look at these companies and I say, well, I just, that's not my type of investment because they are priced huge, like they're, I think it was on 50 times earnings or something like that. But in many ways, this is not .com bubble era. Like this is the risk the market has at the moment is if these guys miss their growth estimates, they're still going to make a huge amount of money. They're still going to make huge cash flows. They've all got net cash on the balance sheet. They don't have any debt. They're probably making tons of money from higher interest rates because they've got so much cash on the balance sheet. But it's really the growth rates that might slip them up because the market is so expectant of ongoing strong growth. And to be honest, Nvidia didn't really disappoint. It did guide towards another strong quarter next quarter. But again, because the market had already factored a lot of that in, the share price didn't move too much. But just to be clear, that these aren't bubble companies. They're genuinely, and they've got economic moats. You just can't compete those earnings away very quickly. So Apple, Microsoft, Nvidia, they're probably the big three, even Google and Amazon to a lesser extent. They're just huge network companies that people use because everyone else uses, and because of that, they've just got entrenched business that competition can't compete away those big returns. So what's going to slow them down is the slowing growth rates. And I liken them in this article. I liken them to the big energy companies of last century. When your Standard Oils, they started growing from small bases in the US, and then when they dominated the US market, they started dominating internationally. We're at that point where these tech companies are similar to those oil companies, where they've got global domination. And at some point you get to the level where you have to grow at the same rate as the rest of the world, because you've already saturated everywhere. I don't follow them close enough to know at what level we're at, but there will come a time where there's growth rates start to hit up against the ceiling, and that's when you're going to see a share price reaction. And that's when the dominant narrative will be, oh, these companies are ex-growth. They're not going to continue to grow for another 10 years at these same rates. They're going to start to more resemble global GDP growth or nominal GDP growth, something like that. In the same way that it happened to the big oil majors. So the big difference with the US companies is once they dominate the huge US market, they go out and dominate a global market. So, I don't know what I'm saying about Mountain or Molehill, but it's a big company with a lot of cash, a lot of profitability, and it's probably got a decent growth runway. Let's go with both.
Yeah. And I think also with such high profitability, it will definitely entice competition. It probably does have a long run time to develop the capabilities of Nvidia, but the competition is definitely on its way. So it'll be interesting to see whether Nvidia's economic moat is sustainable and how strong that is in 5-10 years' time.
Exactly.
Yeah. Well, on that note, I think we will end it for this episode. We will also, I think, in the weeks ahead, or maybe even next week, have a dedicated email address for this podcast, so you guys can send your comments or questions to that email address, and I'll link it to my account, so I'll be able to track what you guys are saying or what you guys are asking. And if we have enough questions, we can go through that at the end of each episode.
Sounds good. And just to let everyone know, I did mention that I'd have a look at the sentiment indicators for the market. Didn't get to that this week. We'll get to that in the next couple of weeks, just because we're in a seasonally strong part of the market, which means November and December are traditionally the best months for the market in the year. So we are at overbought levels from especially in US stocks, a little bit less so in Australia. I think that probably continues for the next couple of weeks at least. So we can have a look at some sentiment indicators just before we head into the Christmas break to see where things are poised. But overall, my view hasn't changed. I think this is just a seasonal bounce from really oversold levels at the end of October. And once the sort of, I guess, everyone trying to get into the market to push their portfolios up to secure those end of year bonuses, which does happen, by the way. Once that has sort of cleared, I think we sort of go into 2024 with the realization that central banks are remaining tight. Yeah. Credit is contracting in the US. The money supply is contracting. The US is going to find it tough, and Australia will follow because our interest rate rises started happening a little bit after the US. So nothing really changed from the bigger picture view, but I think shorter term, obviously, just to reiterate, we're in a seasonally strong part of the market, and it can continue to sort of, drift higher for the next couple of weeks at least.
Great. Well, we'll see you next week. And also, watch out for that email address. We'll probably link it down in the description below. But in the meantime, you can leave a comment or a question in the YouTube comments. And if we get 5 questions in the YouTube comments for this video, I'll wear a hat for the next episode.
Beautiful.
Nice. All right.
Cheers, mate. See you guys. Thanks for watching. Yeah.